So here we get to turn to Asia, and normally we talk China right away, but I think the more important one right now, which is shocking to say at the moment, is Japan and what is happening with the Bank of Japan and what they're trying to accomplish. So we have to look at the yield curve control, and you might be sitting there saying, what is a yield curve control? So it's essentially when a central bank will say this specific maturity, which in the BOJ's case is the 10-year, we are going to hold this at a ceiling of X. So that means that if the bond gets to that yield, they are going to actively keep it at that yield. So what does that mean in terms of the dynamics? What are the mechanisms of this? So if just using the 10-year, so remember, yield and price are inverse. So that means that if yield is shooting up, that means that price is falling, which means that people are selling. So the BOJ has to come in and buy what people are selling to protect the price to hold that yield where they want it. Now, the market is a large, angry beast, and they can say, I am going to call your bluff. I don't think you have the willpower nor the ability to hold this. So I'm going to pummel this and push this until you step back and yield and say, I can't maintain this yield. I'm going to have to let it free float. So what does that mean when they're buying bonds? So they're buying their bonds, which means that when you buy bonds, you give currency. So you're buying the 10-year and you're giving people yen. So that means that the foreign exchange is weakening versus the dollar because you're issuing a ton of new yen and buying bonds in what will end up being a failed attempt of holding the yield at that point. So the problem then becomes, well, how much are you going to devalue your currency? And unfortunately, and for those that haven't or don't remember, the 1998 Asian currency crisis, it was when a lot of these quantitative easing policies out of Japan first came into action. They've adjusted over time. You had Abenomics, you had all these different shifts, but quantitative easing was a large part of policy going back to 1998 because of the Asian currency crisis. So to see the pressure right now back to where it was when all of this began, it really kind of harkens to, did it work? What was the point? Like if you look at Japan, they've been in a no growth profile since the late 90s. So what was gained in trying to essentially avoid a currency crisis or a recession in 1998? And here we are today, back where we are. And then I think a fair question is, what is the out? How do you stop? And the problem with in 1998, the commentary was, you can't. There is no out, because the out is rising rates, which they're trying to protect from happening, and a recession, which for some reason we have gotten away from the fact that sometimes you need the business cycle to cleanse itself. You need a recession to create price discovery, to sniff out the strong company versus the weak company, to reallocate assets in the most effective way possible, instead of just dumping cash into essentially zombie companies that just appear to be growth but are actually grossly negative. So when you look at the Japan 10-year government bond yield holding at that point, and you can see it hitting that line, but the speculation has lifted the implied JGB volatility to the highest since 2008 because they keep trying to drum it up. So the BOJ is sticking with its yield control policy, which is becoming a headache for the central bank. The market wants to take yields higher as inflation rises, and this policy looks increasingly shaky because inflation in Japan, which has been in a long-term deflationary cycle, is now spiking, and the market is pushing this and is tempting them, which is where, and when you look at this curve, which is this beautiful curve of now versus 1 week ago, You can clearly see where they're trying to protect, which is the 10-year, but look at the cost. The BOJ bond purchases hit a record last week to defend the yield cap. And look at how over time they've had to increase that. And now look at where it is, which is where the market is like, it's going to break. I'm going to make you adjust your policy because it's wrong. And that comes back to the article that we wrote in February of last year, where rates are in the driver's seat. So the central banks can try to do what they want to do, but the invisible hand, which as I've said, can be held back but not stopped. And this is this invisible hand where the market is betting that the government's going to yield, and you're going to see a snap up, which again would true up the market and allow things to progress normally. But this is a saving economy. So the problem is, if you let this snap back up, what is going to be what is going to be the bigger issue? What is the reverberating impact? And the problem is you're going to have savings coming back. The fear is that you're going to have less investment, even less spending than you already have, and you're going to shift the paradigm. And if you start to see the yen strengthen, what does that do to exports? So you have these big pushes, which, and just like anything else, like the butterfly effect, where if the yield curve flaps its wings, it reverberates throughout the system, and it happened during a currency crisis. So the fear is that if you get this snapback, that you're going to have investors and essentially people saying that other emerging markets are next. And that's when you have that cascading impact. When you look at 1998, something very similar happened. When you look at the Malaysian currency, the Thai baht, and you had this cascading impact, would this be something very similar? Now, when you shift over to China, which would also be impacted by this, the Chinese bank funds available for lending versus the Chinese credit growth continues to go up, but is still negative. And I think it's important when you look at the different backdrops of the PBOC wants to promote more things happening, but they want to be with an eye of caution towards the leverage ratios and the amount of money they're putting into the market, because you can see cracks just growing all around them, and they know that there is always going to be that reverberating impact. They've already seen their yields rise. They've already seen the inability to get foreigners coming in and purchasing some of their debt. And that's where foreign direct investment continues to be kind of on the hot seat in terms of when does that start to really fall off. All the while, Chinese housing starts versus property transactions continues to be steeply negative. And that is a big issue in terms of, as we talked about in segment one, there's a population problem. Who are you building all of these new homes for if the population is going in the wrong direction and you're seeing this economic slowdown really picking up? And yes, COVID obviously didn't help, but you're not snapping back the same way you did in 2020 because there is a prolonged impact and a lot of ancillary pieces that continue to drive things lower. Now, in the meantime, China is liquidating U.S. Treasury securities in order to provide some of this financing because they need assets to back what they're doing, and they need dollars. So, and you might say, well, they're treasuries, so they pay out in dollars. It's like, but yes, but they need to pull it forward. There's a near-term issue on liquidity and a near-term issue on asset valuation, and which then means what is your collateral? And that is, I think, the biggest problem of what is your collateral. And instead of saying, well, it's the treasuries, they're saying, well, we need to pull some of that forward, which is a downward move on price because China's a net seller, which is, again, putting a bid on our yield. So then China's household leverage ratio fell the most since the great financial crisis, but look at where it is. And so I think it's important to look at where things sit at the moment and the pivots that we're having while household demand for credit crashes because, again, it's not that the credit isn't available, it's that nobody wants it. There is a bigger and bigger issue in terms of credit availability. And again, leverage has fallen because people don't want more debt. And so they are paying off. They're saving more. So again, as they're saving more, their leverage comes down because, again, they're putting more assets behind that collateral, as collateral against their debt. So that's where there's no desire to get new debt. And that's, again, a bigger issue. So now when you start thinking about this holistically and expand it out, senior Chinese officials are getting even more nervous about the labor market prospects of this year's college grads. Because remember, last week we showed that the unemployment of this age bracket is 18.6%. So you're seeing a huge issue on unemployment, and that's married with you still have lockdowns that are rolling throughout. So how are these individuals going to get jobs and become, again, those meaningful part of society? A record 10.76 million students will graduate this year. So here's the government's game plan to date: delay the moment students enter the labor market, incentivize private firms by providing preferential loans to SMEs that employ more grads, offering one-off compensation for SMEs signing longer-term contracts with graduates, order public sector institutions to up their game and hire more. For an example, Shanghai has required local state-owned enterprises to expand their graduate recruitment quotas and reserve over 50% of places for Shanghai college grads. A handful of localities recently restarted COVID suspended civil servant recruitments and plan to expand quotas, again, pulling people back into the government. But as the government, when local governments are struggling with cash flow because of unemployment, because of lack of land sales, because of falling tax revenue, how are you paying these civil servants? The government is pulling out all the stops to try to add jobs. The private sector provides most graduate jobs, and hiring at these companies won't fully recover until the economy picks up, which, as we've been saying, continues to get kicked to the right. With most graduates entering the job market in June and July, we expect the youth unemployment numbers to actually continue to go up. So now when you start looking at steel output is overshooting construction activity, which at what point does that steel get pushed into the market? Because they're sitting there and they're watching these levels increase, but it's the underlying problem of how are you going to do it? And it's a lot of that is tied to there's little investment in infrastructure, even though they keep saying spend on infrastructure, use special purpose bonds, continue to spend. And the local governments and the provinces are saying, on what? What project is there that you can see that I can spend on? So, and then it's made worse by the frustration around the strict zero COVID policy that continues to businesses continue to struggle with. Despite Beijing's relentless drive to underscore the wisdom of the policy, more people are becoming frustrated at an economic forum over the weekend. Outspoken former finance minister Liu Wei put in simply saying that pandemic containment policies are to blame for the private investment slowdown, which is putting more of that steel on the sidelines. From January to May this year, private sector investment increased just 4.1%, limping along well below the almost 13% seen in 2021. The problem at the core of weaker expectations by private businesses is how to balance the relationship between epidemic control and economic growth. The government is exploring and the private sector is watching, but everyone believes that the current methods are not enough. If this problem is not resolved now, everyone is reluctant to invest, which we continue and have been saying since, for a very long time. So it's nice to see somebody locally saying what we've been saying and just reiterating the issues that remain within that segment. So now when you look at lockdowns have produced a huge fiscal shock, which is what we've been talking about on the revenue side. How are these governments going to finance these things given that fiscal shock? Because look at 2020. Yes, it dipped, but look at how far down it dipped and how quickly it recovered. You're not seeing that this time because you have so many overarching issues that continue to get worse, which is why they're trying to push more of that social financing. As you can see, some of it starting to pick back up a bit, but the fear is on the leverage side and how much of that is going to good projects that will actually cover not only principal, but also interest. So the Premier Li was on a tour in Hebei province where he talks wheat, because there's a more and more of an issue. And somebody asked me on Twitter, what has happened with the local Chinese crops, and we haven't gotten a lot of information, but they've been talking about it incessantly. So the combination of COVID-related disruptions to farm work and Russia's invasion of Ukraine, a key grain producer and exporter to China, have sent policymakers into panic over this year's domestic crop yield. Li warned that officials whose poor work impeded the harvest would face consequences because of lockdowns getting things through. Early this month, the State Council pledged support measures to ensure farmers have the resources necessary to haul in a normal harvest. During Li's visit, wheat is one of the main staples of the Chinese people. The sufficient supply of grain serves as an anchor for price stability. It is necessary to sow as much as possible to ensure a bumper harvest of autumn grain and enhance national food security. Food security is quite literally the party's most important bread and butter, which, as we've been talking about from the very beginning, this is the overarching theme in terms of the issues and fears when we look abroad, which is why they continue to focus on harvest. Now, when we start shifting abroad, you can see that South Korean exports on the preliminary side are coming in a bit soft. Taiwan exports kind of bumping along, but remember, South Korea is a bit of a leading indicator, coming back to what we said in segment 1, where we expect to see that global trade continue to slow. South Korea is one of the key pieces of that. Now, on the India sales manager side, you can see that things have pivoted negative. Staffing levels have gotten much worse and are worsening, which again is pulling, and why we are so concerned on India and the pressure that we see on that underlying economy, and why we think India is actually kind of we talk a lot about China, but India is the one that is becoming a bigger problem as we look at, what is happening in 2022. We think both are a problem, but India is the one that is going to have the bigger write-downs, as people have already started to wake up to China's underlying problems. So that's what we have for you today. If you have any questions, please let us know in the comments section. You can follow me on Twitter. I always love engaging. For those that have followed me on Twitter, you know that I try to answer all of your questions. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.